Well, consider I got like a backlog of, again, what I feel the most important things to talk about. I used to just delete some of the old stuff, and I still do like, oh, I'll delete that one. That's not that important. This is more important. And this, again, I find this very important. The Federal Reserve, Economic Collapse blog, Michael Snyder. The Federal Reserve, and I said this last year too, is setting up Trump for a recession, a housing crisis, and a stock market crash. Absolutely. So we were saying, I said, if that man wins, this is what they're going to do. He will reside over the bankruptcy of America, essentially. And they're going to let it happen under his watch. Most Americans do not understand this, but the truth is that the Federal Reserve has far more power over the U.S. economy than anyone else does. And that includes Donald Trump. Politicians tend to get the credit or the blame for how the economy is performing, but in reality, it is an unelected, unaccountable panel of central bankers that is running the show, and until something is done about the Fed, our long-term economic problems will never, ever, ever be fixed. For an extended analysis of this point, please see this article. I'm going to link this to you, of course. And he links the one he's linking, why Donald Trump must shut down the Federal Reserve and start issuing debt-free money. But anyways, in this piece, I'm going to explain why the Federal Reserve is currently setting the stage for a recession, a new housing crisis, and a stock market crash. And if those things happen, unfortunately, it will be Donald Trump that will primarily get the blame. On Wednesday, the Federal Reserve is expected to hike rates. Again, that's today. And there is even the possibility that they will call for an acceleration of future rate hikes. We need to raise them quicker. Economists generally believe the central bank's median estimate will continue to call for 3/4 point rate increases both this year and in 2018. But there's some risk that gets pushed to 4 as inflation nears the Fed's annual 2% target and business confidence keeps juicing markets in anticipation of President Trump's plan to cut taxes and regulations. During the Obama years, the Federal Reserve pushed interest rates all the way to the floor, and this artificially boosted the economy. In a recent article, Gail, which I just read you, also Gail Tverberg, explains how this works. With falling interest rates, monthly payments can be lower, even if prices of homes and cars rise. Thus, more people can afford homes and cars, and factories are less expensive to build. The whole economy is boosted by increased demand, which is really increased affordability, for high-priced goods thanks to the lower monthly payments. Asset bubbles such as home prices and farm prices can rise because the reduced interest rate for debt makes them more affordable to more buyers. Assets that people already own tend to inflate, making them feel richer. In fact, owners of assets such as homes can borrow part of the increased equity, giving them more spendable income for other things. This is part of what happened leading up to the financial crash of 2008, she said. But the opposite is also true. When interest rates rise, borrowing money becomes more expensive and economic activity slows down. For the Federal Reserve to raise interest rates right now is absolutely insane. According to the Federal Reserve Bank of Atlanta's most recent projection, GDP growth for the first quarter of 2017 is supposed to be an anemic 1.2%. It should be over 3.5%, by the way. Personally, it wouldn't surprise me at all if we actually ended up with a negative number for the first quarter. As Donald Trump has explained in detail, the U.S. economy is a complete mess right now, and we are teetering on the brink of a new recession. So why in the world would the Fed raise rates unless they wanted to hurt Donald Trump? Raising rates also threatens to bring on a new housing crisis. Interest rates were raised prior to the subprime mortgage meltdown in 2007 and 8, right? Just prior to that. And now we could see history repeat itself. When rates go higher, it becomes significantly more difficult for families to afford mortgage payments. The rate on a 30-year fixed mortgage reached its all-time low in November of 2012 at just 3.31%. As of this week, it was 4.21%, and by the end of 2018, just an FYI, it could be up as much as 5.52. It could be up to 5.5%. forecast Matthew Poynton, a property economist for Capital Economics. He points out that for a homeowner with a $250,000 mortgage fixed at 3.8%, annual payments are $14,000, again, per year. If that homeowner moved to a similarly priced home but had a 5.5% rate, their annual payment would rise by $3,000 a year to $17,000. Keeping in mind what I've been telling you, nothing changes other than how much extra money you give to the bank. Nothing changes. Same house, same price even. Your monthly rate, sorry about your luck. It goes up to the tune of $3,000 a year. Right? So if there's 12 months in a year and $1,000, you're talking, I don't know what the exact math is, up $250 a month extra. You now have to come up with, not to pay off your note a little earlier, no, just to give to the old bank. The same bank you already gave to in 2008 and 9. Boy, are we some dumb people. We will put up with a ton, won't we? Of course, well, some of you will. I know someone that defaulted on a mortgage and fought. And he won a settlement in the process. Thank you. Thank you very much. I thought I heard some cheering in the background. Not just my green screen. Sorry about that. Of course, stock investors do not like rising rates at all either. Stocks tend to rise in low-rate environments, such as we've had for the past several years, and they tend to fall in high-rate environments. And according to CNBC, a coming stock market correction could be just around the corner. Investors are in for a rude awakening about a coming stock market correction. Most don't know it yet. No one seems to know when the crash will come or what will cause it, and no one can. But what's worst for most investors is they have no clue how much they stand to lose when it inevitably happens. If you look at the market historically, we have had on average a crash about every 8 to 10 years. And essentially, the average loss is about 42%, said Kendrick Wakeman, CEO of financial technology and investment analytics firm FinMason. If stocks start to fall, how low could they ultimately go? One technical analyst that has a stunning record, as I just discussed in my previous videos a couple days ago, of predicting short-term stock market declines in recent years, is saying the Dow Jones could potentially drop by more than 6,000 points down to 14,800. That was Mr. Jadea. He's been Sandy Jadea. I already read you this article a couple days ago. He's been spot on with his calls, and he's saying that there's one coming very soon. And if we don't reach the 22,800 or something Dow, it could possibly fall below 14,800 Dow Jones. Most big stock market crashes tend to happen in the fall, and that is what I portray in my novel. But the truth is that they can literally happen at any time. If you have not seen my recent rant about how ridiculously overvalued stocks are at this moment in history, you can find it right here at this link. Whether you want to call it a crash, a correction, or something else, the truth is that a major downturn is coming for stocks, and the only question is when it will strike. And when things start to get bad, most of the blame will be dumped on Trump. But it won't primarily be his fault. It was the Federal Reserve that created this massive financial bubble, and they will also be responsible for popping it. Hopefully we can get the American people to understand how these things really work so that the accountability for what is coming can be placed where it appropriately belongs, and that is at the Fed. Private criminal banking cartel has their private banks, central banks, practically in all countries, and it's their people that they handpick. Sure, but I thought our Congress has to, they have to go for approval before a committee in Congress. Yeah, they do. And those Congress members, here's a nice fat little campaign contribution. We want this person in there. They're an expert. Okay, I'll sign off on that. And they always do. Just as an FYI, every single Federal Reserve chairman that I've checked back to, going back to Volcker, including Yellen, Jewish. All of them are Jews. What are the chances? I'm just asking. Coincidentally, I know it's a coincidence. Of course it's a coincidence. But I'm just wondering, what are the chances of that coincidence? Okay? Anyways, the Economic Collapse blog, I'll link to this in case you want to follow some of those other links. They are doing this on purpose, and they know Trump is the right guy for us to do this to. The American people will never vote him in for a second term after what we do to him and blame on him. However, all these things that weren't supposed to happen, Brexit, the no vote, whatever, Italy, whatever that was, no vote, Donald Trump becoming president, the polls, everything, they got it wrong. They missed it. So maybe because of the internet, alternative media, us talking, transferring information at lightning speed, everyone will know, oh, you guys are trying to blame this on the president. It's not working. We know it's the Federal Reserve. So the backlash will be, no, don't yell at the president. We want to remove the Federal Reserve. Oh, well, no, we don't want that. Yeah, we do. Yeah, actually we do. I think that's where this could turn to. Anyways, gotta run. Take care.